will share that. Okay, today we are going to do IAS 23. Okay, let us see here. Today we'll do IAS 23 borrowing cost. Now, in your childhood, when you were studying, you recorded something called that as interest expense, right? Used to record in statement of profit and loss that as interest expense. No more. At this level, it is not an interest expense. Title is not interest expense anymore. It is divided into two. It can be either termed as finance cost or it can be either borrowing cost. Two names are given to interest expense in modern times. That is how you, right? Finance cost and borrowing cost, right? So two titles of account. Now, as you know, interest is always given on loan, right? So its finance cost is the interest. Interest reported in SOPL. Interest that we record in statement of profit and loss is called finance cost. And interest we record in reported in SOFP as an asset, right? We add it into cost of asset. So interest reported in balance sheet as an asset, capitalized interest, is called borrowing cost. So interest expense, we don't use that title of account anymore. Interest expense that is recorded in statement of profit and loss is called finance cost. And interest expense that is recorded in balance sheet is called borrowing cost. That is capitalized interest. Okay. Now, what is the technical part in it? Why finance cost and why borrowing cost, right? Take 100,000, 10% loan and purchase an asset. Okay, we take loan, whatever amount it is, and we purchase an outright asset that is called finance cost. Interest we pay on this loan will be called as finance cost, reported in statement of profit and loss, right? So when we take a loan and we make a purchase, right? Don't forget this thing. Please, that when we purchase an asset with loan, the interest paid on that loan will be finance cost, right? And borrowing cost when we take 100,000, 10% loan and self-construct an asset. take 100,000, 10% loan and self-construct an asset. So you have two choices. When you take loan, you have two choices. One is to purchase a build asset, right? I go out and buy a building that is already there. Second option is I take a loan and build my own building, right? So if I take a loan and I pay salaries out of it, that is not a borrowing cost. That is outside the scope of the standard. This standard relates to loan that is used to purchase or construct an asset. That is borrowing cost. Now, so this is the one part that you have to self-construct an asset for interest to be recorded in balance sheet or to add it up in cost of asset. Okay. Now, not every asset qualifying assets only, right? Qualifying assets only. Only qualifying assets. Now, if I take 100,000, 10% loan and I self-construct an asset, that asset has to be a qualifying asset for an interest to be capitalized, right? Now, what are qualifying assets? Qualifying assets are assets that take substantial time period to complete. Now, the key word here is substantial time period. Addis, where did you go?
I wanted to write the definition of qualifying assets and I pressed leave.
Now, that is not a technology drama, that is your drama. Right, so substantial time period to complete. Now, what time period is substantial time period? Right? What time period will qualify as a substantial time period? I don't know. No one knows. Even Samantha doesn't know. Pamela doesn't know. No one knows. See, even Edis don't know. Substantial time period is substantial time period. That means it has to be a substantial time period. Could be 1 day, could be 2 years. I don't know. So in exam, you will always be told that whether it is a qualifying asset or not. It will take substantial time period to complete or not. Right? So that interest will be capitalized. Got it? Okay. So substantial time period. Okay, take a screenshot. I'm going to remove it. Addis, don't say that I was too quick this time. Take it. Okay. Okay, now see, we are taking take 100,000 10% loan on qualifying asset. Right, that means it will be a borrowing cost. It will be capitalized, added in cost of asset. Right, okay. Now the technical thing is for how long you will capitalize an asset. For how long you will capitalize an asset. Where that line goes. Right, now this is one accounting period. Okay, now let's write the dates now. Let's give it a date. 1st January, 1st March, 30 June, 31st August, 30th November. Let's explain it now. Let's finish it once and for all. Okay, 31st December. Right, 1 year. Now, technical point is, the technical point is only interest incurred in construction time period is capitalized. Only interest incurred or paid in construction time period is capitalized, is borrowing cost. Right, now, let's suppose we took a loan on 1st January. Okay, 1st January. Now this is the date we took loan on, right? Okay. From 1st of January to 1st of March, no construction. No construction as we were waiting for weather to be fine, right? We started construction on 1st of March. So this is construction time period. From 30th June to 31st of March. Sorry, 1st of March to 30th June. Now, from 30th June to 31st of August, there was lull. Right, construction stopped for any reason. For any reason, could be labor strike, could be bad weather, could be subsidence on site, anything whatsoever. For any reason, construction stopped. Right, it started again on 1st September. Their construction time period. Not yet, not yet. Right, to 30th November, it's my, sorry, right, construction. And on 30th November, construction completed. That means for last month, there was no construction again. Now, the technical point is that only the construction time period will count. Any time period where construction is not in process for any reason whatsoever, interest will be finance cost. It will not be capitalized. So technically, how long is the construction time period? Here, from 1st of March to 30th June, March, April, May, June, 4 months. And here, September, October, and November. So 7 months. 7 are the months where construction was in process. So borrowing cost is 10,000, 100,000 into 0.1 into 7 by 12. This is borrowing cost, right? And finance cost is 100,000 into 0.1 into 5 by 12, where there was no construction, right? So technical thing that we need to learn is that interest will be capitalized if and only if the construction is in process. Any time period where construction is not in process for any reason whatsoever, interest will not be capitalized. Even if it stops for 2 days, interest will go to statement of profit and loss. Clear? Are we clear in this? Samantha, Addis, Rachel, Pamela. Rachel, where is Eddie, man? I miss him. Is he angry on me? Is he? Is he angry on me, Addis? Oh, that's not good.
Remember, you you didn't allow him to learn, and then when he was trying to log in, you were forgetting all the time. So he's very angry.
He should not be. He did not use the right name. Okay, I'll buy chocolates for him. These days, out of all of us, Pamela is the master of taking care of babies. So she should tell me what should I do to bring him back to class. uh, Human dramas. Oh, yeah. Right now, the last concept. Right, the last concept is investment income earned. Investment income earned is that you see here in the first 2 months where we took the loan, but there was no construction. So what do we do with loan? Shall we waste it? No. We invest and earn. Right? We invest and earn. Now, where will this investment income be shown? Right? So we invest and earn. So investment income earned during the earned during the non-construction time period is reported as other income in SOPL, credit, as credit. Right? It is reported as credit separate, other income. So since this investment income was earned in non-construction time period, so it will be reported as other comprehensive income. And the last line, where do I write it? Okay, take the screenshot, so I'm going to remove it. I have to write one more line before I jump on to kit questions. Take the screenshots, please, quick. Okay. Okay. Last point is any investment income earned during the construction time period is netted off borrowing cost from asset, right? Where we credit the asset. Asset is credited. In non-construction time period, statement of profit and loss is credited. And in construction time period, borrowing cost is credited. Sorry, asset is credited, yes. Okay, that's it with standard. Are we done? Understood? Any questions? Okay. If any questions, write it in the chat box. Otherwise, open your exam kits, please. Let's do some kit questions. No, I can't hear any. If you're calling me a guy, that's fine. I think yes. Only this one left. Oh, it is. Come on. Okay, open your kit and open, please. Test your understanding 7. Test your understanding 7, please. Let me know when you're all there. Kit question number 7. Books page number, screen page 26, and books page number 3. Kids page number 3, sorry. Quickly, we have to do 2 to 3 questions now. Okay. Are you all there, Samantha, Edis? Edis, you go out again, you keep coming in again. Okay, technology dramas. Question, page number 3, question number 7, quick. Okay. Requirement is to the nearest 1,000, what borrowing cost should be capitalized? Right, what borrowing cost should be capitalized? During the current year, An entity had in place 1 million 6% loan and 2 million 8% loan. It constructed a new factory which cost 600,000. Now we have two loans. One is of 1 million and one is of 2 million. 600,000. Out of which loan did we use it? We don't know, right? So if this happens, so which interest shall we use, 6% or 8%? Two interest rates, and we don't know the specifically which loan financing was used. So we will use the weighted average of two interest rates, right? So interest rates is 0.06 into 1 divided by 3 plus 0.08 into 2 divided by 3. Right, so we use the weighted average of them two. Can you find out quickly what is the weighted average of the two interest rates? So we are using technically the weighted average of two interest rates. Page number 3 of the kit. So weighted average will be used as can you someone do the numbers for me, please? Which interest rate shall be used? Not 7, it can't be 7. Do the maths again. It's 6.7. 6.7%. Right, 6.7% will be the interest. So we used borrowing cost is 600,000 into 0.067 into how many months? Well, construction time period 8 months into 8 by 12. Okay, can someone do the number for me, please? Or I will have to do it. Hold it. It's 26,800. Oh, that is not the answer. Hold it. Where did it go wrong? Yes, Samantha. Yeah, what percentage was it then? All right, 7.33. So here, 0.073. 0.73. Okay, thank you, Samantha. What is the answer now? What is the answer? $29,200. So nearest thousand should be 29,000. Yep, B. Nearest thousand is 29,000. So B is the answer. Okay. Okay, now we do, there was a good question one. Question number 14, please. Question number 14. Which one, Samantha? 6 or 14? Okay, 5. Now we did 7. Samantha, was it 7 or 14 is a good question. Okay, so 14 will be even better. Okay, what are the total borrowing costs to be capitalized in respect of the warehouse? Okay, Gilbert took a 7.5 million 10% loan on 1st January X6 to build a new warehouse during the year. Construction of the warehouse began on 1st February and was completed on 30th November. So how many months will be capitalized? 7.5 into 10% into 0.1 into how many months? How many months? 1st February to 30th November, 10 months. So 10 months will be capitalized into 10 divided by 12. How much it is? Can someone do the maths quickly for me, please? Or I will do it. That is 625,000 is the borrowing cost. Capitalized. Now, borrowing cost, that is capitalized. Okay. Now, next is investment. As not, third line, as not all the funds were needed immediately, Gilbert invested 2 million in 4.5% bonds from 1st January to 1st May X6. Remember, any interest earned in non-construction time period is 1 month. And February, March, April, 3 months are capitalized. So investment income in construction time period is netted off. That is 2 million into 0.045 into how much is construction time period? February, March, and April, 3 months into 3 divided by 12. How much it is? 0.045. 22,500 will be netted off. So we will net off 22,500. What is the balance remaining? That will be capitalized. Six zero two 500. So this will be the borrowing cost. This will be remaining borrowing cost, right? And 1 month's interest will be other comprehensive income. 2 million into 0.045 into the original month, 1 month, 1 by 12. This will be the other income. 2 million $7,500. 7,500 will be other income. So we are done with the whole standard now. Did you everyone get it? Any questions? So technically we are done with the whole standard now. Okay, take the screenshots, please. Addis, quick. Quick before you are left answering and asking everyone. Take the screenshots, Addis. Go, Addis, go. Okay, thanks. Pamela, Rachel, I hope you are done. Tomorrow, most probably it will be IAS 20 government grant. A long way to go. Okay, thank you all. Thanks very much.